Now it's the time for a thorough activity. Example: three friends each start a pizza shop. They all have the exact same sales and costs, but they paid for their equipment differently. The reason I have put here the same sales and costs, so in that way you are gonna see the differences better. It is not for simplicity, because it really doesn't add to the level of difficulty of the case you are handling if these numbers are different. The main reason I have put them here the same, so you can see the impact of different financing. And here for financing, we only focus on borrowing. Common facts for all the shops: total sales $250,000 per year, operating costs $150,000. So when you do a quick math, you come up with the golden number of 100,000 as profit. That is operating profit. It is a very important measure in accounting, and it is in fact the profit before deducting interest and taxes. Okay, so this $100,000 is common between all three shops. They are the same, but they have gone through different financing scenarios. Shop A used personal savings, no loans. Shop B took one loan of $50,000 at a 10% interest rate. Shop C took two loans. Loan 1, $50,000 at 10% interest, exactly the same as Shop B. But loan 2 is $100,000 at 5% interest. So we are going to make our approach more quantitative. And so we are going to handle this type of problems more systematically. You remember the first question I asked you? Which one do you prefer? Borrow or share ownership? Okay, so in this case that now you have in front of you, you should do these four calculations. First, net benefit for all the shops. 2, tax shield for all the shops. 3, the real cost of each loan. And finally, the weighted average cost of debt. About tax shield, net benefit would be for all of them. And net benefit is not operating benefit. It is the net benefit you get after deducting tax and interest from operating benefit. Tax shield is the amount of saving reduction you get in your tax payment because of some tax deductible expenses that you had. So for Shop A, we don't have any tax shield. In item 3, it is asking you for the real cost of each loan. When each loan can help you to pay lower tax, it means that the interest rate, the real interest rate, is gonna be lower than the stated interest rate. And finally, for weighted average cost of debt. For case B, since it is only one loan, so any number that you get for the real interest rate, that's it. But for C, since you have two loans, one at rate of 10% and the other one at rate of 5%. So here you need to go for the topic of weighted. And I always say that, don't overcomplicate calculating the weighted average. Whenever you want to calculate your GPA, you are using a weighted average model. Okay, now stop the video, my friends, and patiently start working on this challenge. I'm gonna handle all the answers one by one, so whenever you want to see your answer is correct or not, you can go ahead and check, but make sure you are not spoiling this thorough activity. And as soon as you get a hint, stop the video and try to do it yourself. Because it is the nature of financial problems, financial cases. When you see the answer, everything is understandable. Reading them is way easier than making them. So try to be the person who not only can understand all the things when you look at statements or reports or that type of thing, you can also create them yourself. Okay? Stop the video and good luck. Net benefits for each shop. For shop A, it is 80,000. Shop B, 76,000. And shop C, 72,000. It makes sense. We expected this trend that shop A should have the higher profit, the highest profit, and shop B should have higher profit than shop C, because shop C has bigger loan. The loan that shop C has taken is 150,000. The loan shop B has taken is 50,000 and shop A is 0. So when you look at this, it makes sense that shop A gonna make more money because they don't give interest. And the reason I'm emphasizing on this fact, because when we are talking about tax shield, it doesn't mean that the shop with interest payment gonna have bigger number for the profit. No, they just pay less tax. Okay, let's go for the details of calculation. Total sale for all three of them, 250,000. Operating costs for three of them, 150,000. So we get the operating profit as 100,000 for all of them. Now from here, the interest expense. Shop A, 0. No loan, no interest payment. Shop B has loan of 50,000 and the interest rate is 10%. So the interest expense is 5,000. Shop C has two loans. One 100,000, the other one 50,000. The one with 100,000, the interest rate 5%, and this one 10%. So the payment for this is 5,000. The payment for this is also 5,000. That adds up to 10,000 interest payment per year. Now we have the interest payment, so we can calculate the taxable amount. The taxable amount for shop A is 100,000. That's the part differences will show themselves. Shop B, the taxable amount is $95,000 because they have interest, that is tax deductible expense. So instead of $100,000, they are going to pay tax on $95,000. And finally, Shop C gonna pay tax on $90,000. These are tax deductible expenses. So how much would be the tax of these three? Shop A will pay $20,000, $100,000 times 20%. 20% tax return, and taxable amount $100,000. This times this, we get this. The same formula for calculation of Shop B taxes and Shop C. So what you see is that Shop C is paying less tax than Shop B. Shop B pays less tax than Shop A. Why? Because they are paying interest, and interest is a tax deductible expense. When their operating profit is the same, you can see this trend, and that was the main reason I have chosen all the numbers the same. Okay, now you have the taxes. So here you have the operating profit. Here you have the interest expense. And here you have taxes. Combination of these three things give you net profit. 100,000 minus 0 minus 20,000, 80,000. 100,000 minus 5,000, 95,000 minus 19, you get the results. Okay, stop the video for more reflection on everything we discussed in this slide. If you have any question or anything you need to still work on that, stop the video, because very soon I will show the next part. Tax shield, a quick refresher here. A tax shield is the actual amount of cash a business saves on their tax bill. So, even without doing the calculation here in this slide, I go back here. When you compare these three things, what you get? How much Shop B saves on taxes in comparison to Shop A. Why we can compare them? Because Shop A didn't get any loan. So we can compare them for getting the tax shield. So very easily from here you can notice that Shop B tax shield has been $1,000 because they have paid $1,000 less in taxes, and for Shop C it is $2,000. Okay, but if you don't like this way and you want to do it in a classic way, let's go here. The formula for doing tax shield value is the interest paid times tax rate, because you are not gonna pay tax on the interest paid. So with this formula, we are gonna check. Shop A, 0, because they don't have any loan. Shop B, how many loan? 1 loan. How much is the interest? We don't care about the amount of loan. How much is the interest? 5,000 is the interest, as you can see here. Interest paid. And good news for Shop B, they don't have to pay tax on the interest part. So the rate of interest is 20%. Was it mentioned in the question that The interest rate is 20%. Oh yeah, here we have it in this table, taxes 20%. 20%, so you come up with the number 1,000 that we get to. You are gonna apply the same formula to shop C, and how much you are paying in interest, and we don't care about the combination of this interest, we just care about the payment. So $10,000, we are not gonna pay tax on this, so it would be $2,000. So you see how you can do the calculation in two different ways, but the results would be the same. So here we have the results for tax shield, the amount of cash a business saves on their tax bill because they have tax deductible expenses. Stop the video before you check the answer to part 3. The real cost of each loan. Before we do the math, we know that for example, shop B, that its current cost is 10%. And also, when we are talking about cost, we mean rate. Of course, somewhere you see they specifically mention that the real rate of each loan, but you should have in mind when it says real cost, we can do the dollars that cost you for a loan, or also you can do the rate. Of course, when you mention, as you can see in the PowerPoint, we have both of them, real cost and real interest rate. But many times when they are talking about real cost of each loan, they are talking about the percentage. Exactly the same way when you go to the bank, they just tell you about the percentage, because rate is not dependent on the amount of money you are borrowing. Okay, so when we have 10% for loan 1, we expect that the real rate is lower than that. Or when we are talking about the second loan of shop C and it is 5%, we expect that they are going to be lower. But let's go and do the calculation. Okay, what is real cost? Real cost is interest expense minus tax shield savings. And what is real interest rate? Nominal rate times 1 minus tax rate. It is the formula, and I have always told you never memorize things. At least first understand them before you memorize them. Okay, let's go and see what's happening here for shop A. Since there is no loan, we are not gonna cover it. Let's go for shop B. Interest paid to bank is 5,000. That's correct. So it is the interest expense, 5,000. And we calculated how much was the tax shield? 1,000. So you paid $1,000 less. So in fact, your true cost of loan is 4,000. So you see, even you don't need to check this formula. You have paid 5,000 and you saved here because of that 5,000 you are paying. So the real amount that in fact you are paying out of your pocket is 4,000. So 4,000 is the real cost. And what about real interest rate? Real interest rate, my friends, calculated like this. How much you are paying interest? $4,000, correct? You just calculated. And what is the total amount of loan that you have? 50,000. So what is the result? 8%. Now let's go and check this formula that you see here. What is the nominal rate? 10%. And 1 minus, what is the tax rate? 20%. So 10% times 1 minus 20% equal 8%. Do it any way you are more comfortable. There is no merit in memorizing the formula, but there is so much advantage in understanding them. Okay, we are gonna check the things for the next part also, so it's gonna be a review for you. But as soon as you notice you get some points, stop the video and try to do it yourself. For shop C, loan 1 is exactly similar to loan of shop B. So the amount of real cost is 4,000 and the interest rate, real interest rate, is 8%. But now let's go for loan 2. Interest paid is 5,000. That's correct, because the loan was $100,000 and the interest rate was 5%. So the amount of interest paid is 5,000. Tax shield is 1,000. We have calculated the things, and we know that for tax shield, as you have the formula here, the amount of interest times tax rate. So here, the amount of, because we are working on loan 2 now, the amount of interest paid is 5,000, so tax shield is 10, and real cost is 4,000, and 4,000 over 100,000, that is the total amount of loan, gives us 4%. And also let's use the formula that you see here. Real interest rate equal the nominal one. The nominal one was 5%. That was stated on our agreement with the lender. 1 minus tax rate, that is 20%. I'm sure now you can connect yourself way better than the first time with these two formula that you see here. And that's the reason I always say that first understand, then go for the details, definitions, formulas, or that type of thing. Stop the video, because soon I will show you the answer to part 4. Weighted average cost of debt, the real and nominal. You can see it here. Here it is the nominal one, and here is the real one. Let's go first for the nominal one. We have, for shop C, 2 loans. One of them, 50,000, the other 100,000. So when it says weighted 1, the total amount of loan that you have is 150,000. So how much of this 150,000 is the first loan, and how much is the second loan? The first one is, as you can see here, 0.33, and the second one 0.66. In fact, the first one weight is 1/3, 50 over 150, and the second one is 2/3, 100 over 150. And okay, so the one that is 1/3, that is 50,000, has the interest rate of 10%. And the one with 2/3, that is 66% of the total amount of loan that we have, has the interest rate of 5%. The result gives you this. And that's it. And now you have the weighted average cost of debt. From this, you can calculate the real one with that formula that you have. The nominal rate times 1 minus tax rate, you get it. You may say, I don't want to calculate it in this way. I have used another way and I came with the same answer. That's perfect. Don't worry at all, go with that. Most probably you have done it this way to get the percentage. So you have 150,000 is the total amount. And for that one, you have how much you are paying interest, 50,000 times 10% plus 100,000 times 5%. So 5,000, 5,000. So you have 10,000 over 150,000. If you have done this math, that's absolutely correct. And I'm going to show you here that 1 over 15. You see, the same answer as here. Anyway, you are more comfortable and you understand it, better go with that. Another way, for the other one, again, you say, I don't want to use this formula. I have used another way and I got the same answer. Okay, go ahead with that. You would say that for the first loan in the previous part, we calculate that we are paying, the real cost is 4,000. We calculated it in the previous part. Real cost, you remember? We did the calculations in this part. So you are going to use that. The real cost for the first loan was calculated 4,000. And the real cost for the second loan was calculated 4,000 again. And how much is the total amount of loan? So the real rate of interest is 8,000, the real amount we paid, over 150,000. And also, if you have used other ways and you come up with the same answer, those are also correct. So you see, we got the same answer. 5.33.